The benchmark rate goes up a quarter percentage point to a range of 1.25% to 1.5%. But there is a surprise in the Fed's growth forecast. GDP next year is seen expanding at a 2.5% pace, up from a 2.1% consensus forecast in September, probably due to tax cuts. The effect fades rapidly, though, with growth of just 2.1% in 2019, 2% in 2020, and long-range potential growth of just 1.8%. Unemployment falls below 4%, the Fed says, next year, 3.9% the consensus for next year and 2019. And the inflation rate isn't changed by that. It stays at 1.9%. PCE index for 2018 hits the target of 2% in 2020. Stronger growth, lower unemployment don't change interest rates either. The dot plot stays about the same, with a median forecast consensus of 3 rate moves next year and 2 in 2019, a long-range terminal rate of 2.8%. As for today's decision, well, the members cited an economy growing at a solid pace with solid job growth as you average through the hurricane-related fluctuations. As their forecast shows, they do expect inflation to pick up, although, as they said in September and in November, they are monitoring inflation developments closely. They did change their labor market outlook. Instead of expecting it to continue to strengthen somewhat further, that's the old language. The new language expects the labor market to remain strong, perhaps a little bit of a downgrade in terms of monthly job growth ahead. There were 2 dissents, Chicago's Evans and Minneapolis's Kashkari. The first time that we have seen 2 dissents in favor of a looser policy since 2002. The first time 2 bank presidents have dissented for looser policy since 1983. What to make of it all? Well, probably not too much, given that there is a possibility we'll have 4 new board members and 2 new bank presidents submitting forecasts next year. The dissenters, Evans and Kashkari, rotate out of the voting members of the committee. And after the January meeting, guys, Janet Yellen, the chair, is gone.